Previously on FinFluential. Welcome everybody to the daily recap show where we talk about stocks in the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out, guys. Let's get into it. This is the daily heat map of the S&P 500 and a lot of green in the market, but it didn't start this way. The market actually traded kind of soft into the open, and then as the day progressed, we kind of just rallied, making higher highs, higher lows into the close. And today's rally was really led by the big names: Nvidia, Microsoft, Google, Tesla, Amazon. They were all green on the day. Meta and Apple didn't participate quite as much, but they were still pretty much flat, slightly in the green, and a very green day across the board. But if you do look closely, you can see pockets of red right here in industrials. Healthcare was fairly flat, same too with consumer staples. And then Visa and MasterCard weighed on the financial services sector in the context of what was actually quite an incredibly green day. We saw technology outperform, followed by the discretionary space, and then communication services. And we all know what these three sectors consist of. Comms is Google, Meta. Discretionary is Amazon, Tesla. Tech is semis, Apple, Microsoft. The Magnificent Seven, but it's also got a couple of the other bigger names. We're looking at stuff like Netflix in the discretionary space. All of the software names in the tech space too. And when they rally and they outperform, you're gonna get the day you did today in the S&P 500, up 1% and having its 8th green day in a row. Very bullish stuff, the stuff you see in bull markets, but it was broad-based across all sectors. Even staples was up 0.3% today, and that's just money on the sidelines pouring into the markets. There wasn't a rotation, it was just buy risk assets, and that's why we saw staples up today, materials, financials. And this is kind of crazy when the third worst performing sector is financials, up 0.5 percentage point. That's how you know it's a bull market. We also saw gains across the factor and size spectrum. Mid caps, small caps actually did outperform large caps to a very small degree, both here in the value and core segment. Maybe not so much in the growth segment, but we still saw 1.14% gains in small growth and modest gains in mid cap growth, which you'll take any day of the week. And across the entire size spectrum, small, mid, and large, value, core, and growth, there were gains across the board. And these gains all stemmed from Kashkari's speech. He came out, gave a speech. He's the Minneapolis Fed president, and pretty much said the balance of risks has shifted, so the debate about potentially cutting rates in September is an appropriate one to have. He cited the possibility of a weakening labor market, and when a Fed president comes out and says it's appropriate to debate September rate cuts, and this guy is actually known as Kashkari, he does normally have a hawkish view on things. When he comes out and says, hey, listen, the labor market's weakening, we need to really talk about a cut in September, the market now moves from not if a rate cut in September, but how much? 25 basis points, 50 basis points, and that's why the market rallied here today. But it wasn't just the US market. We saw gains across the board globally, excluding Japan as well as New Zealand. We saw upbeat action here in Asia, China, India, as well as South Asia, looking at Taiwan, Singapore, Australia too. Most of Europe gained, and then North America, Canada, as well as South America. A very green day in the US, globally, Asia, Europe, and that's what you normally get in bull markets. But it wasn't just Kashkari's speech that really moved the market. There was a ton of other tailwinds that the market had. The first was wearing positive gamma. The gamma flip is still at 5,500. That hasn't moved. And the core resistance is at 5,700, this blue line right here, which means we buy dips, sell rips, and look to that as our ultimate target. You can see that we had two major targets last week in the S&P 500, the 55.85 level right here and the 56.70 level. We've actually broken above that on a bullish candle. That's a very bullish candle right there, and that opens up 56.70 and the 5700 area. In the context of the advanced decline line moving to new all-time highs, the S&P 500 not quite at all-time highs, we just draw something like that and like that. That's actually a positive divergence, as well as the market not yet being oversold on the RSI. This does lend itself to continue rallying into the week, and we might not even pull back. However, we are starting to see a little bit of sour action here in the after hours. You see the Qs are down, the IWM as well as the RSP slightly flat, but that is in the context of these sectors, the Qs, the IWM and the RSP rallying 1.31%, 1.22% and 0.76% for the RSP. A very bullish day across the board. We saw mid caps were up 0.91%, the S&P 600 0.86% and the S&P 500 up 0.97%. Very bullish price action. Now I think the thing that really supported the large caps today, and that's why stuff like the Qs outperformed relatively speaking, had to do with the dollar. A weaker dollar is good for corporate earnings. And you can see the dollar fell 0.5 percentage point, and that's in the context of having fallen 0.5 percentage point here on Friday. Very interesting moves in the dollar. I think if the dollar falls too much, that can be bearish, but the effect that a weaker dollar has on corporate earnings right now, that's why we're seeing outsized move in large cap names, because they have this dollar tailwind. And the reason why the dollar fell had to do with the fact that bonds actually gained. The TLT was up 0.46%, nearly 0.5 percentage point. The AGG up 0.11%, and that's because yields actually fell on the day. Now it doesn't look like it right here because this is the after hours price action, but the 10-year yield was actually down 0.33% today. The 30-year yield nearly 0.5 percentage point. However, the 2-year yield did gain. Volatility was down 1%, but on a peak to trough basis, down 8%. And then commodities, gold and silver were very mixed. Gold at 2,500 hitting new all-time highs, just digesting some of the gains we saw right here. Very bullish price action. And there was a lot of constructive news with regards to Ukraine and the Middle East this past weekend, and gold actually didn't come crashing down. So what gold is telling us is that rate cuts are coming more than geopolitical risk. And I do think gold is probably going to go higher. 2,500 is insanely bullish. Silver did actually gain today. Silver on quite the rally above the $28 level, 1.5% today. On Friday up 2.38%, and on Thursday up 2.86%. Quite the rally. I do think we probably go ahead and hit the highs we made earlier in this year. That would be, I believe, 52-week highs. I think we're going to go ahead and see that, but a lot of volatility. But commodities sort of gaining strength in the context of what has been a bit of a dumpster fire for commodities in the last 2 or so months. And then crude was down 2.29%. Now let's dive a little deeper into the S&P 500. If we actually pull up the 1-minute chart, and this is the price action for the S&P 500 on the day, you can see we actually had fairly subdued price action here at the start of the day. The first hour and a half of trade actually dipping into the red, but then Kashkari came out, had his speech, the dollar fell, the yields fell, bonds gained, stocks ripped as a result, and then we just made higher highs, higher lows. And then we had some of the 0 DTE hedges roll off right here, and then boosted us towards the end of the day for the S&P 500 to finish up 0.97%. It was a very bullish day in the context of being in positive gamma, and the market's literally looking like they want to go take all-time highs. I think we're going to go get all-time highs very soon by the end of August, which would be absolutely crazy, because literally August started like right here. We made a huge drop, especially this end of July into August, and then ripped all the way up to go ahead and retake all-time highs. That is quite the move. And again, you know, you look at this on a year-to-date basis, and this higher low is looking very constructive relative to this higher low in the context of us retaking all-time highs. That is bullish, and it's really higher lows, higher highs, new all-time highs. This was a great dip buying opportunity. I'm so glad I bought. I actually did buy more Nasdaq 100 yesterday as well. I think if you are looking for a little bit of value, you can look at something like the Nasdaq 100. It's definitely going to go back to all-time highs as well. But the S&P 500 looks so good. This chart looks really, really good. Now, I'm very eager to see what's going to happen in the gamma chart tomorrow. I think we're probably going to see the put support move up as well as the gamma flip. But if it doesn't, that's okay, because right now 5,500 is probably going to offer a lot of support. And I guess based on this price action, I think the market's going to continue to climb the wall of worry and run into the Fed minutes as well as Jerome Powell's speech at Jackson Hole on Friday. The market loves to climb the wall of worry, or the wall of uncertainty, or the wall of nothing. There's not much economic data this week, so we're just going to be looking at Fed speeches. Are they dovish? What are their thoughts on the September rate cuts leading up into Jerome Powell's Jackson Hole speech, and then the FOMC minutes on Wednesday? And that's really it. Apart from the PMIs on Thursday and initial jobless claims and existing home sales, that's really it. So it's, you know, the Monday, Tuesday, there's not much happening. It's sort of Wednesday, Thursday, Friday, when the market really gets moving with data. And in that time, the S&P 500 will probably continue making its way higher. We could have a little bit of pullback, a little bit of reprieve tomorrow, but we've kicked the week off on the right foot, breaking some of the key levels that we needed to break. And that is insanely bullish. Buy dips, sell rips. Our initial target is the 5,700 and take advantage of any dips we get along the way. We're going to new all-time highs. We're going to the call gamma resistance right here. Diving into Goldman Sachs sentiment indicator, sitting at 0.6, we actually saw a little bit of a tick down compared to last week in the context of equity markets rallying. So the construction of this overall indicator, which just measures stock positioning across retail, institutional, and foreign investors versus the past 12 months. And this is pretty much telling us that there is still a little bit of fear in the market despite the rally that we actually saw last week. Stocks were actually very bullish last week. I think we're going to see a little bit more volatility this week. And this indicator is telling us exactly that. When we do get volatility in the market, and even when we get massive market rallies, we want to pay attention to the fundamentals. And this is consensus EPS revisions. They've been a lot less negative than usual. This part of the reason why we've seen the S&P 500 so far this year 18%, close to 20% in returns, and that's because earnings revisions so far for this year have tracked well above the median. In fact, 2024 earnings have actually been quite stellar. Q1 earnings have been great. Q2 earnings are tracking really well as well, and 2025 earnings, huge up revisions. I do think we're going to see these come down. We normally do get about 8 to 10% in earnings revisions heading into the relevant earnings quarter. So to track above the estimates is very, very bullish. And to actually track upward revisions, that is incredibly bullish as well. But diving into revisions more specifically, looking at Q3 2024, you can see here that on the 10th of July, so about a month ago, a little bit more than a month ago, earnings was sitting at 7.9%. Large cap stocks, you're looking at the S&P 500 currently tracking at 5.4%. Small caps 7.6% on the July 10th, now tracking 0.2%. That's huge down revisions we've seen here for the third quarter. Similar situation in the fourth quarter, 14.1% versus 12.8% for large caps, and then 14% versus 9.8% for small caps. We see a very similar trend in the first quarter of 2025 as well as the second quarter of 2025, but we're still looking at 13.3 and 12.8% earnings growth priced into large caps for the first and second quarter 2025, and then we actually see up revisions right here, 14.4 versus 15.5% in the third quarter and 13.4 versus 13.9% in the fourth quarter. And we see much of the same for the Russell 2000, 19.4% in the second quarter, 24.4% earnings growth in the third quarter, 22.2% in the fourth quarter. So we're seeing very, very mixed earnings right here. A bit of early volatility into the first quarter 2025, and then things look very, very rosy. I do think that we are going to see downward revisions in these quarters. It's actually kind of normal. The market expects it, and the S&P 500 can continue to rally at all-time highs even if we do get substantial earnings revisions. It's just when we get the revisions coupled with the macro, that's when things can get really, really dicey. But the way earnings are looking right now, looking quite robust, except for third quarter earnings here in small caps. This can cause quite a bit of volatility. Other than that, the revisions look normal and actually well above the average median revision. But diving into the year and now, this is Goldman's S&P 500 scorecard for the second quarter, tracking S&P 500 earnings at 11%, excluding financials at utilities 9%, the Magnificent 6 excluding Tesla earnings are tracking at 36% growth, and then the S&P 494 6% growth. So the broader market actually seeing growth in aggregate. The SPS growth, this is the equal weight, actually tracking 4% growth, and then equally weighted Magnificent 6 15%. So yeah, Nvidia really playing a role in these earnings right here. And then looking at overall margins, Goldman Sachs margins tracking at 11.4%, and that's a 40 basis point increase over the last quarter. So we're seeing margin expansion in this quarter. That is bullish, and the median stock is actually seeing 8% growth in the S&P 500. These are robust earnings because Goldman were tracking earnings to come in at about 10.2%. So we're seeing a very healthy beat here in the top line, as well as overall margin improvement, and margins should actually continue continue to expand into 2025. This is real corporate profit per employee and the S&P 500 trailing 12-month profit ratio. And you can see here that when real corporate profit per employee moves up, S&P 500 margins tend to do so as well. We've actually seen margins for the S&P 500 track sideways as employee margins have actually increased. And this supports the thesis that we probably do get margin expansion into 2025, assuming the macro holds up, assuming earnings and earnings revisions continue as per the median. And if this is to be the case, where earnings remain robust in the double digits, margins expand, corporates will very likely put that money into buybacks. And buybacks are set to be very, very strong in 2025, tracking at $1 trillion. That's a 16% increase over the expectation here in 2024. Now, these are forward estimates. We've already done about 60% of 2024 buybacks and tracking at about a 13% growth compared to 2023. And we're tracking very close in buybacks to this 2022-2021 post-COVID buyback period, which we just saw companies dumping money into buybacks because they were making so much earnings, and we're actually set to beat that in 2025. And buybacks often track EPS very, very closely, and to see this at 16% is a good indicator of what S&P 500 earnings might look like. Again, these aren't executed, they are forward estimates. Strong estimates nonetheless. Guys, looking at earnings this Monday, the only two big names we got was Palo Alto ticker PANW as well as Estee Lauder companies. Now, Estee Lauder was down 2% on the day. The earnings are very mixed, but they're still having a lot of China worries, the Chinese economy, and that's why they were down 2% in the context of being down already like 50% this year and just making lower lows from the highs they made in 2021 after the massive COVID run. Crazy what's happening here. That's the second biggest makeup producer in the world. Palo Alto actually produced a rock solid quarter of earnings. They beat sales, they beat EPS, they actually raised their guidance. Previous guidance figure was $9.1 billion. They raised it to 9.12, a slight guidance raise. That's 15% growth, by the way, year over year. And they also increased their EPS estimate and authorized 500 billion shares worth of buybacks. Now, this is fantastic earnings. They were up about 2% in pre-market, 3% maybe. So it seems that a lot of this was priced in. The market was expecting this. Even the guidance raised, you only see your stock go up like 1 to 2%. That is kind of nuts. It just shows how much is already priced in. And let's dive into some macro, guys. Looking at GDP. Now, this is very, very interesting. Look at the consensus estimates right here, and then look at Goldman Sachs predictions for GDP in the third and fourth quarter 2024. Goldman Sachs are staying true to their prediction of 2.6% GDP growth here in the third and fourth quarter, and then 2.1% pretty much throughout 2025, whereas the consensus expectations is 1.5% for the next two quarters. And the consensus expectations are looking like they're gonna come to par. We actually saw the Fed's GDP now on Friday drop to the 2% mark after being here at the 2.9% mark at the start of the week. This was on the back of the housing data on Friday, as well as the industrial production data earlier on in the week. We opened up the week right here at 2.9% GDP tracking, and we dropped to 2.4% on the industrial production, retail trade, and import-export prices. And then the housing starts, we saw a further reduction in the Fed's GDP tracking to 2%. And this is the threshold right here where GDP goes from on trend to looking a little bit sick. We want GDP to be in the 2 to 3% range. Anything below that, and that's generally seen as weak, and it will have an impact on the markets. Now, the blue chip consensus is for about 1.6, 1.7% in GDP. So the Fed's GDP now tracking dipping below 2% might not have that much of an effect on the market. But in perpetuity, you don't want anything below the 2% mark. And at the end of the day, the two big issues with the economy right now is housing and small business investment. Tight policy is having a major impact on the real economy and creating conditions for lower supply in the future. And the quickest fix for this is Fed rate cuts. Now, we do know that at the very minimum, we probably are going to get 25 basis points worth of cuts in September, but that might not be enough because the data we're seeing right now is coming in a little bit weak, and the ball is in the Fed's court. If the Fed just sit on their hands and don't do anything, this is going to have a major impact on the economy and by extension stocks. But if they go ahead, cut rates 25 or 50 basis points points in September and continue to cut rates in the subsequent meetings, I think we should see this data improve into the rest of 2024-25.